EQT Corporation just dropped their Q2 2026 numbers, and they didn't just beat their internal guidance, they completely crushed it. Let's just hit the raw data right out of the gate.
Let's do it.
So production hit 634 billion cubic feet equivalent. And for context, a BNF is the standard industry yardstick for massive volumes of gas.
Right.
And 634 is well above their high-end estimates. Meanwhile, upstream adjusted operating revenues came in at $1.68 billion.
Which is a massive print. And on the bottom line, what did the EPS look like?
Diluted EPS was 34 cents. Adjusted EPS was 39 cents, which that's down a little bit from the 45 cents we saw in Q2 of 2025. But it still brings net income attributable to EQT to $211 million.
Okay, but honestly, the headline that fundamentally changes the trajectory of their year is what management did with the guidance.
Oh, absolutely.
They raised full-year 2026 production guidance by a massive 90 BFE, bumping it up to between 2,375 and 2,450, and simultaneously
Get full-year CapEx guidance.
Yeah.
By $25 million.
Exactly. I mean, that combination is just so rare. Usually, if an exploration and production company wants to raise guidance by that much, they have to deploy more drilling rigs, which means, increasing capital expenditure.
You have to spend more to get more.
Right. But achieving a production raise of 90 BCE while actually pulling 25 million out of the capital budget, it indicates that something in their physical execution model is just operating at an entirely different level of efficiency.
It really proves their operational leverage is working on the ground,
Yeah.
not just in some financial spreadsheet. So that execution on the ground is what we need to unpack first.
Yeah, let's get into it.
Because it's one thing to say you're cutting costs, but we need to see how they're physically doing it without sacrificing future growth. Looking at the operations, capital expenditures came in at $666 million for the quarter.
Wow.
Yeah, that is 9% below the low end of their own guidance. And management was quick to point out this wasn't some accounting trick or
like deferred spending that's just going to hit next quarter.
Exactly. They cited hard operational efficiency gains and lower than expected infrastructure spending.
Which is such a critical distinction to make. When you are operating in the Appalachian Basin at the scale EQT is, infrastructure spending can eat your free cash flow alive if it isn't managed tightly.
Things like laying new pipe and all that.
Yeah, gathering pipe, building out water networks, setting up compression stations. Coming in 9% below the low end on CapEx means their project management teams are doing more with less steel in the ground.
Right.
They are connecting more wells to their network, using fewer miles of pipeline and, fewer hours of contracted labor.
Well, speaking of steel in the ground, we have to talk about the drilling mechanics here, because they just pulled off something absolutely wild.
The lateral well?
Yes. They drilled the longest lateral in the history of shale development, more than 29,000 feet.
That's insane.
I mean, that is drilling horizontally underground for over 5.5 miles. But it's not just the distance. Management noted they stayed 100% in the pay zone.
Which is the most important part.
Right. I mean, it's like threading a needle from the next town over, completely blind, using just telemetry to guide the pit. And they set a new basin-wide 24-hour drilling record and an internal 48-hour record in the process.
Let's actually look at the physics of a 29,000-foot lateral for a second.
Yeah.
Because understanding how they do that explains the massive cost savings.
Okay, break it down for us.
So the pay zone is the specific narrow layer of gas-rich rock you actually want to fracture. It might only be a few dozen feet thick.
Wow, that's it.
Yeah, it's tiny. You are sending a drill bit miles deep, turning it 90 degrees and pushing it out 5.5 miles. The telemetry you mentioned involves sensors behind the drill bit sending real-time gamma ray readings back to the surface.
The engineers can actually steer it through that specific rock layer in real time.
Exactly. Because if they drift out of that pay zone, they're essentially wasting money.
Far worse than just wasting money.
Way worse. If your drill bit drifts out of the pay zone into barren rock, you still have to case it with steel. You still have to cement it and eventually fracture it. You end up spending millions of dollars pumping high-pressure sand and water into rock that yields zero natural gas.
Which destroys your margins.
Exactly. So by staying 100% in zone over an unprecedented 5.5 miles, EQT maximizes the productive capacity of every single dollar they spend on that well.
They extract exponentially more gas from a single surface location, which aggressively dilutes the fixed surface costs, like the drilling pad, the access roads, the rig mobilization.
Right, which perfectly explains how they are driving down their unit costs so effectively.
Let's look at those margins. Total per unit operating costs came in at just $1.03 per McPhee.
And a McPhee, just as a reminder, is 1,000 cubic feet of gas equivalent. It's essentially the base unit of revenue.
All right, thanks. Doing that for a buck and change is at the absolute low end of their guidance. Breaking that down, gathering costs were 9 cents. Lease operating expense, or LOE, was just 10 cents.
That LOE is phenomenal.
We did see selling, general, and administrative expenses SG&A tick up slightly to 17 cents, though. The report noted that was driven by higher long-term incentive comp and professional service costs.
True, but despite that slight bump, this lean structure generated $1.048 billion in operating cash flow, which translates to $330 million in free cash flow attributable to EQT.
Yeah, that's huge.
To put that lease operating expense in perspective, an LOE of 10 cents is just incredibly lean. LOE is the daily cost to keep the gas flowing after the well is already built.
Routine maintenance, surface equipment, things like that.
Exactly, water disposal. Running all of that at a dime per McPhee shows how efficient they are once these wells are turned online.
So that slight tick up in SG&A to 17 cents is basically negligible.
Pretty much. It's essentially a rounding error when you compare it to $1 billion in operating cash flow. The key takeaway is that the efficiency they are creating miles underground is surviving the income statement and actually hitting the corporate bank account.
Okay, I have to challenge the durability of this, though. A 5.5-mile lateral is an incredible engineering feat, but are these efficiency gains actually structural?
What do you mean?
Well, I look at this and wonder if it's just, a lucky quarter heavily weighted by one mega well and some favorable weather timing.
Ah, I see. It is a valid skepticism. But the mechanics behind their guidance paint a very structural picture.
Okay.
The primary driver for raising 2026 production by 90 BCR wasn't just drilling faster. It was better than expected benefits from their compression investments.
Right, compression. That's how you keep the gas flowing as the natural pressure of the reservoir depletes over time.
Exactly. A typical shale well produces like a fire hose on day one, but by year 2, the natural underground pressure drops and the volume tapers off rapidly.
So instead of having to constantly drill new holes to replace that lost volume, compression just keeps the existing ones breathing longer.
That is the exact mechanism. EQT is installing massive surface compressors that essentially create a vacuum. It lowers the surface pressure so the remaining gas in the rock can flow out much easier.
Oh, wow. So they're artificially pulling it out.
Yeah, and by optimizing the system pressure, they are improving both existing legacy wells and newly drilled wells by shallowing the decline rates.
And shallowing the decline curve means the well stays highly productive for much longer.
Exactly. That is a structural change to their entire acreage, not just a one-off lucky strike on a single well.
Okay, so it's brilliant engineering. But, engineering doesn't matter if the market economics are working against you.
Very true.
It is great to pull gas out of the ground for $1, but if regional pricing is weak, you lose all your margin before the gas ever reaches a consumer.
And Appalachia is notorious for that.
It's exactly. Looking at realized pricing for the quarter, EQT posted a differential of negative 67 cents. Now, normally a negative differential isn't something to cheer about, but management pointed out this was actually favorable to their guidance, despite a widening basis during the quarter.
We really need to explain what that widening basis actually means for a company operating in Appalachia.
Yeah, lay it out for us.
So, the Appalachian Basin sits on a massive amount of natural gas, but the region has severely limited pipeline capacity to export it to the rest of the country.
So it's basically trapped.
Exactly. It is essentially a giant bathtub with clogged drains. Because the gas is trapped locally, prices in the basin often trade at a steep discount to the national benchmark, which is the NYMEX Henry Hub.
And that discount is the basis differential.
Right. And EQT beat their internal guidance on this differential through strategic marketing and a very deliberate curtailment strategy.
In other words, they looked at the flooded local market and simply refused to sell their gas at rock-bottom prices.
Yes. They choked back production on certain wells when local prices dipped too low. They elected to just keep the gas safely in the ground rather than sell it for pennies.
So managing their flow perfectly protected their margins.
Exactly.
But curtailment is a temporary fix. You eventually have to sell the gas.
You do.
That is where EQT's recent demand deals come in. And honestly, this feels like the core strategy shift at the quarter. They just signed a 10-year definitive agreement to supply 325,000 decatherms per day to the new CPV Shea Energy Center in West Virginia.
Which is a massive deal.
Yeah. And for context, a decatherm is roughly equivalent to 1,000 cubic feet of gas. This CPV facility is a 2-gigawatt power plant. But the crucial part of this deal isn't the sheer volume, it's the pricing structure.
Right, because it's linked directly to PJM power prices.
Yes, which gives EQT a massive uplift compared to standard in-basin natural gas prices.
This is exactly where we see EQT evolving past just being a traditional driller. The PJM interconnection is the regional transmission grid that coordinates wholesale electricity across 13 states.
And power prices on that grid are significantly higher, right?
Much higher and way more stable than trapped Appalachian natural gas prices. By structurally linking their 10-year gas supply contract directly to the electricity price, EQT is essentially capturing the profit margin of a power plant.
But without having to actually spend billions to build or operate the plant.
Exactly. They are arbitraging the difference between cheap, trapped local gas and premium regional electricity.
That is a brilliant long-term moat. But then we look at the other deal they closed this quarter, and, well, this one requires some serious unpacking.
The propane terminals.
Yeah. EQT spent $77 million to acquire all the operating subsidiaries of Blackline Midstream. This gives them 2 propane storage and distribution terminals in New England.
Right.
They're the largest propane facilities in the region, 46 million gallons of storage capacity, with rail, waterborne, and retail distribution access. EQT is an upstream natural gas giant. Spending $77 million on New England propane terminals feels like a total distraction from their core business.
On the surface, totally. Buying propane tanks in New England seems completely outside their wheelhouse. But you have to look at the physical logistics of the natural gas liquids they already produce.
Okay.
When EQT drills for natural gas, they also extract liquids, like propane. Before this acquisition, EQT stated they were already supplying roughly 60% of Blackline's propane volumes.
Wait, really?
Yeah. EQT was selling that propane to Blackline at a wholesale price. Blackline would then hold it in storage and distribute it to New England during the winter, capturing a massive retail premium.
Ah, because New England doesn't have the pipeline infrastructure for heating, so they rely heavily on trucked and shipped propane when it gets cold.
Spot prices skyrocket in the winter.
So EQT essentially bought the toll booth at the end of their own highway to capture that retail markup.
A textbook vertical integration play. By acquiring the terminal, EQT absorbs the retail and waterborne distribution margins for themselves.
That makes so much more sense.
Right. They secure flow assurance, meaning they guarantee a physical destination for their product. And they can utilize that 46 million gallons of storage to hoard propane when wholesale prices are low, and then sell it when winter spot prices spike.
And the financials actually make total sense, too. At a $77 million purchase price, EQT expects this to generate roughly $15 million in average annual free cash flow over the next 5 years.
Which is a 20% free cash flow yield, with minimal ongoing capital requirements.
Wow. They are optimizing the molecule all the way from the wellhead in Pennsylvania to the burner tip in a New England home.
And they aren't just optimizing domestically either.
Right, the LNG deal. They announced a 5-year LNG offtake agreement with a large Asian integrated energy company for 0.5 MTPA. That's million tons per annum starting in 2028.
Right.
They will use various Gulf Coast liquefied natural gas facilities to facilitate this. And EQT expects this specific deal to boost their 2028 free cash flow by about $45 million, based on recent strip pricing.
It is the exact same philosophy applied globally. Whether it is the PJM power grid, New England propane markets, or Asian LNG demand, management is aggressively transforming their revenue profile.
They refuse to be just an upstream driller subject to the whims of local Appalachian price volatility.
Exactly. They are acting like a sophisticated midstream and marketing company. They're diversifying their end markets to ensure their ultra-low-cost production always finds the absolute highest bidder globally.
Let's transition to the balance sheet, because playing aggressive offense with acquisitions and long-term deals is great, but we really have to see what the defensive line looks like for you as a retail investor.
Let's take a look.
EQT exited the second quarter with $5.7 billion in total debt and $5.5 billion in net debt. To put that in perspective, just 6 months prior, at the end of December 2025, they were sitting on $7.8 billion in total debt.
Deleveraging at that speed fundamentally changes the risk profile of the company.
Yeah, wiping out roughly $2 billion in total debt in 2 quarters isn't just, trimming the fat around the edges.
Not at all. They generated $4.1 billion in operating cash flow over the first 6 months of the year, and they are utilizing it exactly how the market demands.
Right, repairing the balance sheet and dramatically reducing their go-forward interest expense.
And with total liquidity standing very strong at $3.6 billion, they have massive operational optionality right now.
Yeah, wiping out $2 billion of a roughly $8 billion debt pile in 6 months is just massive. That is like paying off a quarter of your 30-year mortgage in just 2 quarters.
It structurally changes the break-even point for the entire company.
But let's look at the risks, because at $5.5 billion in net debt, they still have a significant burden.
They do.
And the report highlighted that gathering expenses actually increased year over year in Q2, moving up to 9 cents per McFay from 8 cents. Management noted this was specifically due to higher volumes being gathered by third parties from wells they turned online in the first quarter.
Which proves they are still exposed to third-party infrastructure bottlenecks.
Mm.
That third-party gathering risk is a persistent constraint in Appalachia. If your drilling efficiency outpaces your own internal pipeline infrastructure, you have to pay a premium toll to move that gas on someone else's pipes.
Which slowly eats into that incredible $1.03 per unit operating cost.
Exactly.
And beyond infrastructure bottlenecks, what about macro pricing? With $5.5 billion in net debt, if natural gas prices take a prolonged macro dive, are they overexposed?
Well, that exact vulnerability is why those demand deals we just discussed are the most critical part of this entire earnings report.
How so?
If a company is heavily indebted and relying entirely on local spot market prices for natural gas, a macro price crash will absolutely destroy their equity. The cash flow dries up and the debt service consumes the company.
Oh, wait, I see how this connects. By locking in these long-term prices outside the basin, like the PJM power deal and the Asian LNG offtake, they aren't just boosting revenue.
Yep.
They are effectively fortressing their balance sheet. If local Appalachian gas prices crash, these out-of-basin contracts act as a physical hedge. It protects the cash flow needed to service that $5.5 billion in net debt.
You nailed it. And physical long-term hedging is far superior to relying purely on financial derivatives. EQT is structurally insulating themselves.
That makes a lot of sense.
We also see this defensive posture in their midstream investments. They noted in the report that they are accelerating capital contributions to the MVP Southgate pipeline project.
Right, committing $85 million to de-risk it and complete construction by year-end 2026.
Exactly. Every dollar spent on long-term demand contracts or midstream integration is a dollar spent ensuring their gas has a physical premium path out of the basin. It guarantees the durability of the cash flows that service their debt.
Okay, so bringing this all together, this quarter paints a picture of a company firing on 2 very distinct cylinders. On one side, EQT is operating at absolute peak efficiency in the field. They perfectly executed a 5.5-mile lateral well, completely blind. They drove the daily cost of operating their wells down to a dime, and their surface compression investments are shallowing decline rates so effectively that they raised full-year production by 90 BCF while actually cutting their capital budget.
And on the other side, they are aggressively acting like a midstream and marketing giant. They are vertically integrating into retail propane in New England, locking in premium electricity pricing on the PJM grid, and securing global LNG demand.
So they strictly control the costs at the wellhead, and they strategically control the margin at the final destination.
It's an incredibly strong position to be in.
I want to leave you with a final thought to chew on. In the earnings release, CEO Toby Rice specifically noted that as power generators and data center developers increasingly look to secure reliable, long-term energy supply, EQT has become the partner of choice in Appalachia.
Which is a very deliberate choice of words.
Yes, it is. As artificial intelligence drives absolutely unprecedented electricity demand over the next decade, look closely at that PJM-linked power deal EQT just signed. Ask yourself, will natural gas producers like EQT eventually be re-rated by the market, not as traditional fossil fuel extractors, but as critical tech infrastructure partners powering the AI revolution? If you want this kind of no-fluff, straight-to-the-numbers earnings coverage every day, make sure you hit follow on the show.